Hi there, good afternoon and welcome to the Mutual Fund Corner. I'm Mangla Malu. With me is Sumaira Abdi. Like every Tuesday and Thursday, we answer all your mutual fund related queries. Before that, we take a look at the markets. Well, it's been a fairly volatile day after the sharp decline that we saw on the frontline indices yesterday. We opened with a bit of a rally and saw some greens, and that has been sold into. Currently, we're off the highs of the day for both the Nifty, the Sensex, as well as the Nifty Bank. More importantly, the mid caps continue to underperform, and the market breadth has weakened from the start. In fact, all through the month, we've seen more declines than advances. This morning, at the start and in the first few hours of trade, we did see the advance declines being at an even keel, and now we see that gap between the reds and the greens declining further. Nearly 1250 stocks in the red for 900 in the green. It's the troubled stocks which are lower as we speak. Yes Bank, that's the one that should come up for you, down about 9% from the highs and currently sitting with a cut of around 8%. We have Indiabulls Housing Finance as well. Remember, that stock has been fairly troubled, down around 21% this month itself, lower by about 6% as we speak. And in the mid-cap space, we have Jet Airways down 40%, Reliance Infra down 13%, Reliance Cap down 8%, and now just as we speak, Piramal Enterprises also seeing a fair bit of selling. So the frontline indices mildly in the green, while the mid-cap end of things and the broader markets are seeing a lot of pain, and that pain continues. First up, all the top stories, and then we hand it over to Sumaira to answer all your mutual fund related queries. The market takes a sudden knock. HDFC Twins and Reliance under pressure. Mid-cap index too under pressure. Vulnerable stocks like Jet, DHFL, Reliance Infra and Jain Irrigation hurt. Jet Airways slides around 50% intraday after receiving no acceptable bids for the cash-strapped airline. SBI moves Mumbai NCLT against the company on behalf of the consortium of lenders. First hearing is tomorrow. HDFC AMC loses over 2,000 crores in market cap on the news that the company will provide liquidity arrangement on certain fixed maturity plans with exposure to the SL Group. Consumption stocks, they trade weak after a Goldman Sachs report says FY20 has started off on a weaker footing than any other year in the recent past. Downgrades Dabur to sell. And in news coming in from the capital, the countdown to the budget begins as Prime Minister Narendra Modi is set to hold the first budget meet later today. Additionally, BJP Member of Parliament Om Birla is appointed as the new Speaker of the Lok Sabha. With that, we have Sumaira in the Mutual Fund Corner with an expert to answer all your queries.
Mangalam, thanks very much for that. Firoz Aziz of Anand Rathi Financial Services joins in this afternoon. Hi Firoz, good afternoon. And before we get talking about mutual funds, let me congratulate you on making it to Fortune India's 40 under 40. And of course, it's been a pleasure being associated with you over the last decade. So a big round of congratulations to you.
Thank you so much, Sumaira.
Okay, but we don't
much.
have much time to celebrate because things are changing so rapidly in the mutual fund industry and for investors that there really is a lot to talk about. So today, of course, we've seen HDFC AMC, or rather overnight they announced to the exchanges that they would have this liquidity arrangement that would be put in place for FMP investors who had exposure to the SL Group. The FMPs, of course, which have either already matured or will be maturing right up to September end, which is when the standstill agreement with the lenders comes to an end, pending a resolution or a stake sale by the SL Group. Now, a couple of grey areas still remain regarding this announcement. And Firoz, I want you to come in on that. One is that they have mentioned that this liquidity arrangement would be done at prevailing valuations. What does that mean for an FMP investor?
See, what happens is, I think it's important for the asset management company to provide liquidity when they have taken something which is beyond the objective of the scheme. So that's point one. Point two, the value of that debenture, face value, is not what is going to be considered for the asset management company to buy those NCDs. So what would be considered is the market value, which I think is the right thing to do, because underwriting the face value of the bond is something which is not right or something which is beyond the means of an asset management company. So it means that there will be certain degree of haircut which the FMP investors will have to take and not just wait for the standstill agreement to actually lapse. So this will mean a certain degree of haircut. If 100 rupees is the bond value, maybe the market value today would be 80, 75. So that's the kind of haircut which unit holder will have to take in his or her value before this liquidity becomes a benefit to him or her.
Yeah, that's what I would have thought as well. But, Firoz, there have been cases in the past as well, right? I mean, in 2016, Franklin Templeton had a similar arrangement for regarding JSPL. You had informed me about, JP Morgan with Amtech Auto. Way back in 2009, there was, Birla who had the similar arrangement with for Wockhardt. How does a regulator look at this? I mean, is there any danger of a regulatory lapse in this case?
See, I think in principle there is a certain degree of, if not a complete lapse, but at least going out of the border of the objective of the scheme. But having said which, I think the asset management company has the interest of the unit holder right up there, because sometimes when you've personally lent it without an asset management company, would you take the same action? I would, because it's important to recover the money rather than try and sell the pledged collateral, which itself could be a chicken and egg, and when you're trying to sell the collateral becomes worthless in itself. So to prevent that situation, especially when asset management companies lend against the own equity of the person whom you're lending it to, where you're giving debt but pledging equity, and equity is a riskier instrument than debt. So point one, Sumaira, I think this arrangement is only to protect the unit holder's interest. But point two, there's a learning for the asset management industry that when you're lending to a corporate, taking a collateral of the same corporate in the form of equity, even if there's a 2-time cover or a 3-time cover, will definitely not be good enough for you to try and cover the interest of the bondholder. So that's the most important learning, and I hope the asset management company picks up from here and doesn't go through the same episodes over and over again. Like you said, it's been something which has happened 8-10 years back as well. So I think we have to learn and not do the same mistake again.
So this is completely, Firoz, at the prerogative of the AMC, right? So it's not binding on, say, someone like a Kotak to introduce this arrangement for their FMP investors.
No, definitely not. What happens is when it is specific to an AMC, like you rightly pointed out, Sumaira, do all AMCs have the capacity to underwrite and a liquidity infusion? I think it will be each AMC's board's decision. But in this case, HDFC has been proactive in doing so. Will other AMCs follow HDFC? Maybe, yes. But having said which, the fact that the AMC is ready to provide liquidity itself means that the probability of recovery before the end date is very high. If there was a low probability, HDFC, AMC couldn't have actually. So that's a very unbiased actual opinion of the AMC and the honest opinion of what is the probability of recovery. Otherwise, it will be very difficult for AMCs to infuse such capitals of 500 crores and have a low probability of recovery, because it's very thinly traded in the market. It will not be very easy to toss off this NCD to maybe an FII or an FPI. So AMC might have to hold it till the end. So that's the positive news for those FMP holders who have not had a full redemption, that if AMC is ready to buy back that NCD at a market price, that itself implies that there's a reasonable probability of a recovery because it is collateralized. And if managed,
yeah, that's true actually. So even at the end of this, they would have 1.5, 1.7x cover on whatever they're buying back from investors, which is the SLNCD. So I guess shareholders should also be taking some heart from this positivity. All right, Firoz, we have a couple of queries that have come in. So first up, we have a query that's come from Sharmila Nair. She's written to us from Mumbai. So she has quite a wieldy portfolio, actually, about 21 odd funds in the portfolio, and we should just start running those funds for you. The investment horizon is 10 years. Currently, there are no SIPs which are ongoing, so most of them as of now stand as a lump sum investments. What she wants to know is that with an objective of wealth creation, what kind of changes would this portfolio require?
Actually, Sharmila's portfolio will require a reasonable degree of revamping because she has 21 schemes, like you rightly highlighted, Sumaira. I think the key learning from this scholars portfolio, which is Sharmila's portfolio, is 21 schemes are actually like buying the entire market. If you actually combine these 21 schemes, unwrap them, and check how many stocks does she in turn end up owning, Sharmila would be owning somewhere close to 500 shares. So it's very difficult to beat the market by owning the entire market. So Sharmila is paying a fee with a clear understanding that it's going to be very difficult for this portfolio to beat the benchmark indices as an overall. So what is the key takeaway is don't have more than 7 to 8 funds, however large the portfolio is. So Sharmila, please compress this portfolio, if not surgically, at least transitionally into a 7-8 mutual fund portfolio, point one. Point two, I think systematic investment plan should be a way of life. If you've done lump sum investment, it automatically implies that you accumulate first and then you make a lump sum investment. If you combine accumulation and investment together, it will be more profitable, can push up the return by 2-3% a year. If you don't accumulate first and reinvest, you accumulate and invest together, which is what SIP does for you. Let me read out 6 schemes for you. Reliance Large Cap, Mirai Asset Large Cap, Kotak Standard Multi Cap, L&T Mid Cap, Canara Robeco Emerging Equities, and lastly, SBI Focused Equity. These 6 schemes are very contemporary, and in my opinion, you will not need a review for the next 2 years if you chose these 6 schemes. This will give you an exposure to 190 stocks, and there's a reasonable probability of beating the benchmark indices, even on the Nifty side and the individual fund side.
All right. So Firoz, since she already has lump sum investments, does she look at redeeming any of them? I mean, barring the 6 that you have suggested, and therefore reinvesting them in these funds?
So I would say, I think sometimes because you've bought schemes over periods of time, she wouldn't have bought 21 schemes on a specific day. Sometimes a completely zero budget kind of a strategy has to be adopted, or a ground zero, as you would like to call it. Redeem everything if you don't have an exit load, and if you don't have a tax implication, especially grandfathering would have ensured that you have minimal tax implications. So if I was Sharmila, I would redeem everything, clean all of it up, and invest in these schemes, because this 21 schemes is an outcome of several transactions and several decisions over years. So it makes sense to bring it to ground zero and take it from there.
All right, that makes sense. Do stay on, Firoz. We'll take a very quick break. There's lots more to talk about when we return. Do keep it with CNBC TV 18.